Hi, this is Dr. Cooper with the second half of the lecture video for Chapter 12 in Managerial Accounting 321 at the University of Maryland. In our last lecture for Chapter 12, we were talking about how to calculate the cash flows from a long-term project that spans over a period of years. The reason we're doing this is so that we can actually calculate and compare projects with each other. So we have a bunch of cash that we have to outlay for a project or an investment that we want to make. And that money has to be laid out today in the current time period. And then in the future, that investment is going to pay back returns. And those returns are going to come back into the company and hopefully will earn a profit on the project that we've invested in. We're going to look specifically, and we did last time, look specifically at the cash inflows and cash outflows. And so here's what we did last time. We had this company, we looked at the money that was coming in over a period of time and then the expenses. We calculated the income tax that was related to that and any tax benefit that we got from it. And then at the end of the period, we went through and we calculated how much money we were going to have to pay out to dispose of the product or project or any money that might come in. And then we came up with final ending cash flow numbers for each year. So in year 0, that's today, we'd pay out $680, and then we'd get back these 4 amounts in the next 4 years, which is fine. The only problem is that when we have money that is coming back to us far into the future, more than 1 year in the future, we need to take into account interest. The time value of money comes into play when we're dealing with projects that are longer than 1 year. And the time value of money basically means that if we're going to be receiving money far into the future, it's going to be worth less than money we receive today. Money we have today can be invested, and we can then earn interest on that money while it's invested. If it's not going to be coming back to us today and we have to wait for it, then we're not going to earn that interest. So we have to deduct that interest from the amount that we're receiving in the future to compensate us for the amount of time we have to wait. So the idea is that each of these future amounts needs to be pulled back into the present value so we can evaluate the project effectively and have all of the dollar amounts all on the same level playing field. We want to make sure that we're comparing apples to apples. And so all the year's cash flows need to be discounted to the present time using the PV function in Excel or in a calculator. Or you could use a PV table. There's links in the homework. And then we can have one number for the whole entire project. And if it's positive, we want to take the project. And if it's negative, then we don't. So we're going to talk a little bit more about that today. And the cool thing, though, is that we can then compare 2 different projects with each other and see which one we want to do more. And especially if we have limited funds to invest. This next part of the slideshow talks about calculating the weighted average cost of capital. I'm not going to ask you to do that in this class. That is something that is more geared toward a finance class. I do need to warn you, if you do want to look into this slide, there's an issue on the bonds information right here. It says that it's $500,000 of 10% 20-year mortgage bonds selling at 90% of face value. That's actually incorrect. If you go into the chapter, you find out that this slide is made incorrectly. It's actually 8.396% bonds. They're selling at 90% of face value with an effective interest rate of 10% using the yield function in Excel. So just heads up, the slide's a little bit off if you decide you want to look that up. But basically the idea is that when we have money in our company, it has to come from somewhere. So if we make the money ourselves, like from our operations, then we'll pay the taxes on it, and then it's our money that we have, and we don't have to pay anything else in order to keep and use that money. But all the rest of the money we get in our business that comes from loans or investors, it has a cost associated with it. And that cost is either going to be interest that we have to pay or dividends that we have to pay. So this problem just walks you through calculating one percentage amount. And in this problem, it ends up being 13.3875. One percentage based on how heavy the market value is of each of these different financing sources. So see here, we've got a bank loan and we have to pay 12% interest. We have a bond and we're not really paying 10%. It's 8%, but it effectively ends up being 10%. We have interest on the bonds. And then we have preferred stock that we end up paying 10% on in dividends, and common stock that we pay 20% on in dividends. This 15 is not correct. It's based on that 20. The 10 is based on this, and that is based on that. Yeah, there we go. And then another part of this is that the taxes, the tax rate only affects the interest, the bank loan interest and the bond interest, because interest is tax deductible, but dividends aren't. That's the whole point of double taxation in a corporation. We get to deduct our tax, our interest, and that, so we get a tax benefit. Anyway, bottom line is, this is the company's weighted average cost of capital. That's how much they are paying for the money that they're investing. So if they have to borrow money for the investment, they're effectively paying 13% on that money that they have. So if they're going to invest it, they need to earn more than 13% or 13.3875%. Otherwise, they're borrowing money at an interest rate higher than, or an interest rate, I guess, higher than what they would be getting in return. So when we do those present value calculations, like I was showing you back here, we want to make sure that it's at least, in that example, 13.38%. That's the weighted average cost of capital. So we would use that percentage. You don't have to use the weighted average cost of capital. You can have you can just pick whatever percent you want to earn on the project and use that as your discount rate. But the book goes through a lot of detail explaining that we want to use the weighted average cost of capital at least. Okay, so moving on. Making the decision, the net present value model. Net present value means that you have discounted all of the cash inflows, discounted all the cash outflows, and then add them together or net them. So net means you take a positive and a negative and you combine them, and then you have a net number. And so if they're two present value amounts, if you have a positive present value and a negative present value and you combine them, then you have net present value. So that's what NPV stands for, net present value. If the net present value is higher than zero, you accept the project, because that means that it is paying higher than your weighted average cost of capital, higher than your discount rate, higher than your hurdle rate, and those are all three the same. If the net present value is less than zero, you would reject the project because it's not paying as much as you are for the money you have. So a net present value of exactly zero means you're breaking even. So you borrowed money at 10% and then you invested it and earned 10%. So you're exactly breaking even. So we want to invest in net present value projects, or in projects that have a net present value greater than zero. We did this last time, how to do the net present value, 36. Yes. Okay. Internal rate of return. Let me go through this really quick, and that will help us and with some of the homework. So, and then I'll jump over to the homework problems. So here, internal rate of return. In the Mendoza company, that's the one we did last class. We did our cash flows. So here's all of the different cash flows. And they did a net present value formula to calculate the net present value. That's not exactly how I did it. I did the present value of each one individually. I didn't do the NPV formula, but either way, we still got the same answer at the end. So we've got this net present value of 36,115, which there it is again. That's more how I did it. I did the info amounts and the PV factors and found the present value. And you can also use the formula if you want. 10% is the weighted average cost of capital. So you put your interest rate in there and add 1 and then negative to the power of -1. Don't do that. I don't think that formula is right. Don't do that. Okay. But one thing I said was that if the net present value is greater than 0, you accept the project because it's at least meeting the hurdle rate. Okay, so in this project, we're at 36,000. Obviously, 36,000 is greater than 0, right? So the weighted average cost of capital, or I'm sorry, so the return on the project is greater than 10%, which is the weighted average cost of capital, because we use 10% as the discount rate in the net present value calculation, and it still came up positive. So that means this project is giving us more than a 10% return. So what percent return is it giving us? I mean, more than 10% isn't really a great number. So we have a way of figuring that out. It's called internal rate of return. And you can do the internal rate of return in Excel. It's pretty simple. If your internal rate of return is higher than your weighted average cost of capital, that's a good sign. And that means your net present value will be positive or higher than 0. If your internal rate of return is less than your weighted average cost of capital, then your net present value will be lower than 0 and you should reject it. So basically, it's just another way of calculating whether or not you should accept the project, but you'll essentially come to the same conclusion. It's just maybe we want to know what the IRR is in this setting. So what is that internal rate of return that we're earning on this project? We don't know. It's more than 10 though. All right, so you can do the internal rate of return pretty easily in Excel. So let me pull up Excel here. And I'm going to do the formula along with them. It says I can actually click on it here in the slide and it'll open Excel, but every time I do that, my laptop has a little baby heart attack and slows down impossible speeds. So I'm just going to have Excel over here on the side. All right, so I've got year and cash flow. Year 0, that's today. And then end of year 1, 2, 3, and year 4. Okay, so these are my cash flows. And I can calculate the present value of each of these cash flows. So equals present value, and I did these last time. The weighted average cost of capital they want us to use is 10%. So when I type in PV, the first thing it wants me to put in is the rate. So 10%, number of periods is equal to whatever year it is. There's no payment because we're doing each one of these individually for each year. And then the future value is the cash flow amount that we're getting in the future. For that one, it's the same because it's year 0, but there we go. Okay, so this is the undiscounted cash flows here. Undiscounted net cash flows, and then this is the net present value. Discounted cash flows. Oh, right. I got to turn all these around because the answer is always an opposite sign. There we go. 36,115. Okay. So that is how we got those numbers. So even though it looks like we're going to make $234,000 profit on this project, when we take into account the time value of money at 10%, which is our weighted average cost of capital, then it's not actually $234,000 because a lot of this money is coming in 4 years. So it has to get discounted 10% for every single year out that every year we have to wait. So we're actually only getting 36,115. But again, because it's higher than 0, we accept the project. So it's a good project. So we want to know what is the amount of interest that we're actually earning. So IRR is the internal rate of return. And we can calculate it by putting the cash flows into the IRR formula. And it'll tell us what the percent is. So it's not 10%, it's higher than that. So equals IRR, and here's the values here. And we don't have to put in a guess. So IRR values, we don't have to put a guess because that is in brackets. If you want to, you can. We can put in 10% as our guess and see what it says. 12%. And then that's what they've got here too, 12.31. Yeah, 12.31%. Okay, there we go, 12.31%. So that's how much this project is earning. It's earning 12.31%, not 10%. And if we do the net PV, the MPV at 12.31%, it'll give us a net present value of 0. So we can do the MPV formula. The rate is 12.31%, and then here's the values. Value 1, 2, 3, 4, 5. 0. Yep. Perfect. That's exactly what we wanted. So if you have your discount rate the exact same as the amount of return, it'll give you a net present value of 0, which is good. That means we're breaking even. If that was our actual weighted average cost of capital, it's 12.31%. All right. Modified internal rate of return. So this is adjusted to account from an assumed rate of return associated with interim project cash flows. And this assumes that all this money is reinvested at the weighted average cost of capital for the remaining life of the project. I'm not going to have you guys deal with this at all, so don't worry about the modified internal rate of return. Okay, I want to talk about 2 other calculations that we're going to look at in this chapter that aren't the net present value calculation. One is called the payback period calculation, and this is basically just you calculating how long it'll take a project to pay for itself, but not taking into account the time value of money. So the payback period, you can actually calculate it pretty easily once you have the cash flows. You don't have to do the present value calculations. You can basically just do like a running balance. And as soon as it becomes positive, then you know that you've earned your money back. So when we start, we're 680 in the hole. And then at the end of year one, we'll get 194 of that back. So we're still 486 in the hole. And then we'll get 245 at the end of year two, almost there. End of year three, we've only got to make up 53,000, and there we go. So it's 3 and a little bit. So whichever year it turns positive, that's your payback period. So in this problem, the payback period is 4 years. So pretty easy. This suggests that you get these dollar amounts at the very end of the year. So at the end of year 4, you'll get that 287,000, and then you'll be positive, and your running balance will finally, your project will have paid for itself. If you don't get the money at the very end of the year, then you can calculate an amount in years and months. So for example, the amount we need in year 4 to get to 0, so if we wanted to break even, is only 53,000, but we're getting 287,000 that month. So we could do 287,000 divided by 12. So this is the year 4 monthly payback rate. So 23,917 per month. So if you look at it that way, monthly payback rate. So if you look at it that way, to get to 53,000, then you would do month 1. So what, well, you could do January. And then in February, you'd get that much again, 47. And then in March, you'd get that much again, 71. Okay, so there we go, 3rd month. So if you wanted to be really technical, you could say 3 years, 3 months is the payback period. But only if you get your payments every month instead of every year. So if you only get paid at the end of the year, it's 4 years. But if you get paid at the end of the month, it's 3 years, 3 months. There's a formula here in the slides that says net initial investment divided by annual after-tax cash flows. This only works if you get the same amount each year. So don't use that formula unless you're getting the exact same amount every year, which in this problem that I've been working on, in this Mendoza problem, they're not. They're getting 194, 245, 188, 287. They're getting a different amount each year. So the formula, that calculation formula, won't work. And you can see it says when after-tax cash inflows are expected to be equal. That's the key. They have to be equal in order for that to work. Look here, so you can see that, oh, they've got a different after-tax number at the end there. Oh, well. Okay, so let's go to the strengths of the payback model. Easy to understand. It's a rough measure. It's not a very good measure because it doesn't take into account the time value of money. Drawbacks doesn't take into account the time value of money, and fails to consider returns over the entire life of the investment. So it's just kind of a baseline calculation. It shouldn't be used, the only tool used to evaluate a project. You can base your idea of risk on the payback period because projects with a long payback period are more uncertain because you're forecasting farther and farther out. If you want to have a very, very accurate estimate, then shorter payback periods will be easier to predict. Okay. Here they're doing a present value payback period. So they went and did the present value of each year and then did the payback period. So you could do that if you wanted to. So we would just do the same thing that I did before, a running balance, and then add the new amounts on each year that you're getting. It's still going to be 4 years. There, yeah. And that's the 4th year. So your payback period is still 4 years, even if you do the payback period on the present value. Okay, accounting book rate of return, or just accounting rate of return, ARR. This one, you actually don't use the cash flows. So in all the other calculations, the net present value and the IRR and the payback period, you're using cash flows. Accounting rate of return uses net income. So you see here, net operating income. So you take your operating income and divide it by the amount of the investment. So here we've got book value of the project at the beginning, 680. Oh, darn it, I didn't mean to do that. So that's the 680 that we're investing. And then the amount we get at the end is $203,000. So let me go to my spreadsheet and see. 234 is what I have. They have 203. Oh, they have an exhibit of where that came from. Well, I don't want to look it up, but then they've got the income after tax for each year. Then they went back and calculated the net income, and that came from way back that project that we were doing earlier last class, and got their average operating income. And they took that average net income, divided it by the amount of the investment, and got 13.14%. The calculations that I'm going to have you do for ARR are going to be far more simple. Okay, so that's all that I wanted to talk to you about in this chapter. I'm going to make another video going through the homework problems because some of them get really sketchy, and I know you guys are getting pushed to the limit. So I want to make sure that you're feeling comfortable with the homework and how to find the answers in the assignment. Please feel free to email me if you have any other questions. I'll talk to you soon. Bye.